Hello, fellow Rebel Capitals. Hope you're well. So Jeff Gundlach comes out and gives a big warning, very similar to Jamie Dimon, but he also expanded on the froth, we'll say, in the S&P 500 and the AI bubble. Let's go right over to CNBC and check out. I had to adjust the volume there. Sorry if I just blew your eardrums. If I just exploded your eardrums there, my volume was turned up way too high. Okay, that should be better. Let's go over here. The title, Jeffrey Gundlach sees one of the least healthy stock markets of his career, urges 20% in cash.
You're not sharing your screen.
Yeah. Boy, we've got all the technical difficulties going on here all at once. All right, hopefully that's a little bit better here. So Jeffrey Gundlach sees one of the least healthy stock markets of his career, urges 20% in cash. I don't know why. I'm assuming he's saying cash and then maybe even bonds, or I don't know if he's using bonds as cash equivalent. Let's see here. So Gundlach urging investors to keep about 20% of their portfolio. One reason why I highlighted this is because I wanted to remind everyone what Warren Buffett is doing. And Warren Buffett, as we speak, I don't know if he's got 20% of his portfolio in cash, maybe even more, but he's got the highest percentage of his overall assets in cash right now that he's ever had. And if you look at times when he goes overboard on Buffett buys T-bills, but when he really goes to these extremes as far as the percentage of his portfolio that's actually in T-bills or cash, it's usually before stuff hits the fan. I mean, the last time he did this to an extreme was 2006, like 2007. I think he did the same thing back in 99. So, I mean, he's got a good track record there. We see Warren Buffett doing this. We see Jeff Gundlach saying or suggesting to do the same thing. And by the way, Warren Buffett has the opportunity to buy his shares back. His shares have come down quite substantially, at least last time I checked. This was as of maybe 2 weeks ago. And he opted to not buy his own shares back, even though he's got $400 billion in cash. So think about that. Right now, Warren Buffett would rather have his money in T-bills than in his own stock. I think that tells you pretty much everything you need to know. And then you've got Gundlach pretty much saying the exact same thing. But Gundlach kind of expands on this. He says, today, speculative excess, in AI-related stocks and data center investments, cautioning that momentum investing during a boom can end badly. Actually, it usually ends badly. And by the way, he gave this interview on Bloomberg. I believe it was the Odd Lots podcast. He goes on to say he is especially worried about the rapid growth of private credit. Now, this goes back to the cockroaches that Jamie Dimon was referring to. And whether it's Tricolor, whether it's First Brands, UBS shutting down hedge funds. And today we had Blue Owl, or it might have been yesterday. But I've got a story here that I'm going to go over. Blue Owl was going to merge two of its funds until the market said, yeah, no, we're not going to accept that, because why are you merging these two funds that are almost exclusively focused on private credit? And by the way, merging these two funds is what they're going to do, I think, through an IPO. And the catch there was they were going to lock you in to where you couldn't redeem your investment until like the deal goes through. And it's like, okay, well, when is that going to happen? That can happen in a year. That can happen in 2 years. And I think that's why their stock took a big hit. Basically, the market said, no, we're not playing this game. This is way too risky. But this just falls in line with pretty much everything else that we've been seeing, with not just private credit, with shadow banking, with all of these cockroaches. We continue to use that term. And then also what we're seeing with the money markets. And the term in terms of like SOFR, in terms of repo and the standing repo facility being used by the Fed. We're seeing all this lack of liquidity, and everyone always blames it on a lack of bank reserves, which I think the more I study this stuff, the more that becomes harder and harder for me to believe or even take seriously, because you just scratch beneath the surface, you do some research, and you see that it's just it's you know, there's no certainties, and no one understands, because no one can get into the mind of the participants that are charging a higher interest rate in repo than, let's say, and by the way, repo, as most of you know, is a collateralized loan. It's a secured loan. So why are they charging a lot higher rates in repo than they are with Fed funds, which is just interbank? And by the way, the interbank loans, they're not secured. So you've got unsecured loans here and secured loans here. And the only difference is the counterparty. These are trading at a higher interest rate, the secured loans. And you're telling me that risk doesn't matter? It's all about bank reserves? I don't, it doesn't really compute. It doesn't really add up. So, anyway, getting back to this, my point there was to highlight the fact that we are definitely seeing a lack of liquidity, and we're seeing a lot of strains in the system. And uh, this is also why you see the Fed's repo, the standing repo facility, being used, because those counterparties get too high of a rate in tri-party repo, which is the real repo market. So this lines up with what we're seeing here with Gundlach, what we're seeing with Buffett as far as his actions, not necessarily his words. Lines up with what Jamie Dimon is saying as well. It lines up with what we're seeing with Blue Owl and these other private credit funds that are, let's just say, under some strain right now. And it also lines up with what we're seeing in the real economy. We have an article that we're going to go over right here from Target that saying that they expect, earnings and revenues to continue to contract. Like Target, it's a pretty good bellwether for the real economy. But getting back to this article, the next big crisis in financial markets is going to be private credit. This is Gundlach. It has the same trappings as subprime mortgages, mortgage repackaging had in 2006. Again, this is not George Gammon saying, oh, this is similar to the GFC. It's Jeff Gundlach saying that. Gundlach also criticized the push to sell private credit funds to retail investors, calling it a perfect mismatch where there's a promise for easy withdrawals, despite the fact those assets can't typically be sold quickly. So, I mean, this is a great point. What you're doing is the underlying asset is very illiquid, but yet you're telling people that they can withdraw. I mean, that, that's basically, well, I was going to say it's like Silicon Valley Bank. Not really, because those investors can withdraw any time. But if you do need the liquidity, then you're going to take a huge, huge haircut. So here, you can't even take a big haircut. You just have zero liquidity. So you can't get a bid. And when you have that kind of that mismatch, as he's talking about, that usually ends badly. And it's obvious why. It's obvious why. I mean, think about that. If you went out there and bought and borrowed, let's say $100,000, right? And you said to the person you borrowed it from, I will pay you back at any time. If you want, you just call me tomorrow and I'll pay you back. Or you could wait a week, or you could wait a month or a year, whatever. Whenever you call me back, you have this $100,000 on demand. And then you take that $100,000 and you buy a piece of farmland. Well, you see a problem with that? You see a problem with that? And it's exactly what we're doing here, or it's exactly what they're doing with a lot of this private credit, to Gundlach's point. If investors pull money out, funds may be forced to sell at steep losses. That's if they can sell at all, right? If it's that illiquid, they might not even have a bid at any price. He said he still likes gold, but has reduced his recommended allocation to 15%. Gundlach could recommend 25% mid-September based on his belief that inflation would stay stubbornly elevated because of the impact of tariffs on import prices. So, yeah. I mean, I'll give him a pass on that one, but it's not exactly what played out. We haven't really seen, inflation has remained stubbornly elevated if you want to use the Fed's target as a benchmark. don't know that it's all about the tariffs, though, because although the consumer is picking up a little bit of that, it's mostly just the importers taking a big hit on their margins. Okay, now let's go over to this Blue Owl deal. Blue Owl calls off merger of its two private credit funds after announcement rattles stock. As it should. I mean, think about it. If you're invested in one of these funds, first of all, what the hell are you thinking? Like, oh, you've got a higher risk tolerance than I do. That's for sure. But if you're invested in one of these funds and you just get a notification, I don't know if they email you or something and say, oh, yeah, by the way, we're merging these funds. And as a result, you're not going to be able to redeem until the deal's over. And we're doing this at a time when private credit in other places is completely blowing up. I mean, I'd say hell no, absolutely not. And I think that's probably the call, or they got a lot of those calls from investors, and the investors showed their dissatisfaction by the stock completely tanking here. This goes back to the 21st of October, where it was trading 17 bucks roughly. Today it's trading down $13.45. But getting back to the article here, it also added to concerns about the state of private credit industry among investors, especially the area that has started to heavily finance the AI data center. So the reason I highlighted this is just to show you, first, we start with subprime auto. And all the bulls come out and say, oh, this is no big deal. It's contained. I don't know what you're worried about. And then we're like, yeah, maybe we made some of these bad loans to AI data centers. And the AI data centers maybe used fraudulent collateral. Or maybe we're building out all these AI data centers because it is true that AI, the demand is going straight up. But where's the money? Like, show me the money, right? Like Tom Cruise. And right now, when Tom Cruise is saying, show me the money, OpenAI or Chat GPT or OpenAI, whatever you want to call it, is sitting there saying, oh, we'll show you the money. Look, we've got $12 billion in revenue. And then the market says, yeah, okay, but what are your expenses? Oh, they're 500 billion, but don't worry about that. So let's all remember that at the end of the day, for AI to work out, well, not for it to work out, because I think it's definitely going to be there. It's definitely the part of the future, just like the internet was. But for these companies to justify their valuation and to have all these data centers work out, then you need profit. You have to have profit. And if there's no path to profitability, I don't know, or if that's an unknown, then that has to be priced into the market cap of these big hyperscalers or whatever the hell we're calling them now. And, you know, I've said on this channel since I started it way back in 2021 that whenever it's a corporate CEO, or especially back then, the central planners, the politicians, whenever they say something that just really doesn't make sense, you almost know with 99% certainty, we'll say, that it's propaganda, or they're just straight lying to you, or maybe both. And the example I'll use is when Jensen, he was pushed. I listened to him on a podcast the other day when he was pushed a little bit about, well, okay, it's great that you're profitable. I mean, you're making massive amounts of money. No denying that. But all these people that are buying your GPUs, I mean, are they going to make money? Like, how's OpenAI going to actually turn a profit here? And he's like, well, what you have to realize is the global GDP is 120 trillion. And then he said, like, half of that goes to paying labor. And AI is just going to completely replace the labor. Therefore, the profit or the revenue potential for OpenAI is 50% of global GDP. I'm like, whoa, Jensen. You got to pump the brakes. And that was actually his argument. And the people interviewing him, like CNBC or whoever it was, they're just like, oh yeah, okay, moving on, next question. Well, that explains it. There you go. It's going to be half of GDP without even like thinking that one through a little bit. And let's say take his argument at face value and say that you've got someone that you're paying $100,000 to, or let's just say that you've got an aggregate total people that you're paying $50 trillion to. Okay, let's say that you can go ahead and replace that with AI. Fantastic. That doesn't mean that you're going to pay OpenAI or Anthropic or whoever it is. It doesn't mean that you're going to pay the AI producers or whatever they're called, service providers. It doesn't mean that you're going to pay them 50 trillion because you're going to be like, no, I'm doing this to get a discount here. I'm doing this to reduce my payroll. So I'll pay you 20 trillion. And then, and again, I'm using aggregate numbers to keep it simple. And then what's going to happen is Gemini or whatever XYZ company or some company from China is going to say, oh, we'll do it for 10. Okay, great. Now we're at 10. And it's just going to keep going down until you get to the point where it's just like the energy costs plus 1%. They turned into a utility. And now, does that benefit the entities that are reducing their pay? Absolutely it does. Absolutely it does. But they're not the AI companies. Now, maybe there's some tech companies with Google and maybe you could argue Amazon. They'll have a huge benefit. But for the vast majority of this, and then what's going to happen with those companies that are accruing the benefit from using AI and not having to pay those employees $100,000 each is they're just going to, hopefully, if the free market is allowed to work, they're going to pass those savings onto the consumer, because then the consumer has options and they'll say, wait a minute, company A who's using AI is dropping their prices by 10%. I'm going to go with them. And then company B is going to be like, well, we'll drop our prices by 15%. The consumer, okay, I'm going to go over there. And then company A says, we'll drop it by 20. You see, you keep going down to where it becomes massively deflationary, but deflationary in a way that's going to be, would likely be really, really bad for lenders, creditors, but it would be really, really good for the consumer. So then they go on, now going back to Blue Owl here, I just wanted to point out the fact that the issues in private credit might not just be contained to subprime auto. That was really the point of that rant, that tangent. Okay. The CEO says both funds remain strong with excellent fundamentals. What does that even mean? Strong. Okay, that's how are you defining strong? And excellent fundamentals. Okay, well, based on what? Based on what type of analysis? And of course he's going to say that, right? That's exactly what they said with Lehman Brothers like 3 days before it crashed. So now that the fund merger has been terminated, OBDC2 will allow investors to redeem in the first quarter. I mean, if you're an investor now, like what are you, as soon as that first quarter comes along, if I'm an investor, I'm like, hit me. Give me my money. Give me my money. Show me the money. There's no way, because this is, to me, is a big red flag. And it's like, why are you merging the funds to begin with? Okay. So now let's move over to Target, because see what we're doing here is we're going from Gundlach and talking about these issues to the private credit issue he was talking about to everything I talked about in repo that you guys understand with these money markets. And then now we're moving over to the real economy, but it's really all the same story at the end of the day. It's all the same story. All right. Target cuts profit outlook as shoppers look for deals. I wonder why they're looking for deals. Probably because the economy is booming. Wrong. Because the economy is brutal. And the economy is great for the top, 10%. I mean, it's the K-shaped economy that everyone talks about. The problem here is that the K-shaped economy is dependent upon asset prices. And if we are in an AI bubble where prices start to come down, very similar to what we saw during the dot-com bust, then what does that do to the K-shaped economy? The K-shaped economy turns into a little H shaped economy. That's why it's a small H where everybody is up here, then woo, straight back down. That's really the risk here. Okay, but getting back to Target. Target posted third quarter sales decline. By the way, I was in the United States a couple weeks ago speaking at the New Orleans Investment Conference, and I actually went into a Target because it's one of the few places I can find pants that are long enough. And it was a ghost town. I mean, it was like a total ghost town. I couldn't even find, I literally walked around there because I wanted to, what was I doing? I think I was wanted the key to the what was it called? To the dressing rooms. And I literally walked around the store like 5 times and I couldn't even find an employee. I'm like, there's no employees, there's no customers. There was someone at Starbucks, but I'm like, what is going on here? So this comes as no surprise based on that anecdotal evidence I saw in New Orleans a couple weeks ago. Key talking points. Third quarter sales decline. Okay, they cut the top end of its full year earnings guidance. Incoming CEO is trying to kickstart the business after roughly 4 years of stagnant sales. Target said Wednesday, and why has it been 4 years of Target sales? Is it because they just absolutely suck? Or why has it been roughly 4 years of stagnant sales? Excuse me. Is it because Target sucks? Probably not. It's because 75% of the United States has been in recession. Now, in aggregate total, when you combine the people at the top with the people at the bottom, or the other 75%, let's say, has it been a recession? No, it hasn't. But for the 75% of Americans, basically, it is a recession. All the characteristics of a recession is what they're dealing with on a day-to-day basis. Okay, Target said Wednesday it's launching an experience with OpenAI. I love this. So your stock is tanking. You're talking about how third quarter sales are going to suck. You're cutting your top end, but then you have to give them some little crumb of positive news. So you're like, oh, but don't worry about all this, bad economy, customers, lower demand, fewer sales, cutting top line. Don't worry about that because we're adding AI, as though that's somehow going to change something, as though adding AI is somehow going to change the plight of the average Joe and Jane. Keeping up with technology is not Target's problem. The economy is Target's problem. It said it anticipates adjusted earnings. Okay, details. We don't really need that. We are focused on every day making the right investments, the right decisions. Okay, yes, that's of course what he's going to say. Okay, this is the net sales. We got that. Oof, there you go. So this is not what you would see in a bellwether stock if the economy was booming. You would not see it go from $140 this year to 88. And what's that, a decline of 45%? I mean, and this guy's announcing his retirement right here. That's not a good sign. So we just have to look at the Chipotles. We have to look at the CarMax. We have to look at the Targets of the world and just put the pieces of the puzzle together. And any way you look at it, the economy is very unhealthy. And the economy, like Gundlach said, right? It's not just the worst or the most unhealthy stock market he's ever seen. I would add it's probably one of the most unhealthy economies, or unhealthy economies outside of a recession that the NBER would officially call a recession. I think that's the best way to characterize what we're dealing with right now. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.